Okay, welcome. This is Click and Close's 2023 version of our anti-money laundering training. My name is Steve Cook, and I'm with the Compliance Department, and I will be hosting this training today. Before we get started, a couple of housekeeping items. Number one is please remember that by law, all Click and Close employees are required to participate in this training on an annual basis. And number two, part of that training is there's a second step to completion of this training. After you participate in this video, there's a comprehension quiz. The link to that comprehension quiz is a short 10-question quiz, but the link to that can be found on the initial email that you got, where you got the link to this video. There's also a link on that communication that will direct you to the quiz, and please go and complete that. It takes both those steps to satisfy the requirement of this training. So with that said, let's get started. Again, this is anti-money laundering training. So the Bank Secrecy Act, also known as the BSA, was legislation that was passed in 1970, and it was passed to help combat financial crimes. The Bank Secrecy Act is administered by the Financial Crimes Enforcement Network, also known as FinCEN. And back in 2012, they expanded the regulatory reach to include non-depository residential mortgage lenders and originators. That is to say, their reach expanded to include companies like Click and Close. So as part of that, the BSA requires financial institutes to develop anti-money laundering programs and to report on financial crimes. So what is required from this law of Click and Close, other than you have to take training every year? Well, what's required is that Click and Close must maintain a compliant AML program, and also we must report suspicious activity to FinCEN through the filing of suspicious activity reports, and that's what we're going to look at today. Compliant AML program includes 5 things. The 5 things are: number one, it must have a designated compliance officer. The compliance department administers the program, but it must have a compliance officer dedicated to the program. Currently, that is me. And number 2 pillar that goes with AML program is that we must have written policies and procedures, and those policies and procedures must be readily available to all employees. Our policies and AML policies and procedures can be found out on Mortgage Machine. Number 3, for a compliant program, it requires an ongoing and relevant training of all employees. That is what brings us here today together. AML training is required at onboarding, but it's also required on an annual basis thereafter. Number 4, for a compliant AML program involves independent testing and auditing. That means an outside third party on a regular basis has to audit our AML program for any kind of findings, but also for recommendations to how we can better our program. And finally, number 5, due diligence, customer due diligence. And that is, we have to have policies and procedures that identify and verify the identity of customers, that monitor and report suspicious transactions, and maintains and updates customer information. So this training is called anti-money laundering training. So what is money laundering? Well, the simple definition of money laundering would be it's an illegal process of making large amounts of money generated by criminal activity appear to come from a legitimate source. So basically, money laundering is a criminal activity that takes dirty money that has been derived through illegal means and making it appear to be clean, so that in order that they can use it without uh, any suspicion being put upon them about the source of that money. Uh, the process, money laundering process, is a three-step process. First step is placement. That is that illegal money has to be placed into financial institutions, just like our money is in financial institutions. Their money needs to be placed in financial institutions, and they do it the same way that we do it. They just deposit it into those institutions. They just have to be a little bit more careful about it. They have to use deposits, multiple institutions. They can use businesses that they commingle the illegitimate funds into those businesses and deposit them as if they're part of the legitimate proceeds from that business. But somehow they have to place that into financial institutions. Once it's placed there, process layering begins. And layering is simply money, layers and layers of legitimate money being mixed with illegitimate money. So it gets to the point that no one could be able to tell the difference. No one would be able to tell the source of those funds because they're mixed in with legitimate funds. No one would be able to tell the illegitimate source of those funds because it's mixed in with money whose source is totally legitimate. Once that layering process has happened and the criminal feels that there's a little chance that anyone would be able to trace back the source of those funds, the third step is called integration, and this is where now that dirty money has gone in, it's been layered, now it's clean, and now they feel that they can tap into that money and use it for whatever they want to without anybody questioning the source of those funds. So that's the money laundering process. So BSA also requires that we report suspicious activity and criminal activity. So when is suspicion to be reported? Well, number one, the law tells us that anytime we suspect fraud or some other type of crime is being perpetrated by any party involved in any click and close business transaction, we have to report that. So in other words, if we suspect something in any area of click and close is business, we suspect something illegal is going on, we by law have to report that. When is suspicion reported? Suspicion is reported when we begin to see red flags. When we go about our daily business, we are in the mortgage industry, and in the mortgage industry begin to see red flags popping up, whether that's in processing or wherever that's at. Red flags begin to pop up. What's a red flag? A red flag is a warning signal of possible danger. A red flag does not mean that there's a fraud, but it is simply a warning that you need to be alert. They can be warning signs of possible fraud. Not necessarily means there is. It's just a warning flag goes up, and what that means is your awareness level needs to increase and go up. Also, when is suspicion reported? Just using our gut instinct sometimes as we, from our experience and from just our gut instinct that, hey, I'm working on this and something just doesn't seem right. Something just ain't right. I'm not sure what it is. There might be a couple of red flags that help draw that out, but just something just doesn't seem right. And if you can't kick that feeling, and especially if there are some other things like red flags popping up, that is when you need to report something. So the law tells us to report, red flags tell us to report, and our gut instinct, if something just ain't right, tells us when we need to report suspicious activity. Fraud. We are in the mortgage industry, and there is lots of fraud in the mortgage industry. Mortgage fraud is defined by the Mortgage Bankers Association as any misrepresentation to the lender from a mortgage applicant for the purpose of being approved for a mortgage that the applicant would not otherwise qualify in order to obtain property or simply profit. That definition does say from a mortgage applicant, but fraud is also perpetrated by insiders, people that actually work in the mortgage industry, whether they be LOs or real estate agents or appraisers or title people or attorneys. Fraud just doesn't just involve applicants. According to CoreLogic's 2023 Mortgage Fraud Report, you can see on the screen there that they report that they estimate that one out of every 134 loan applications has some kind of fraud involved in it. It's a little bit more for purchase applications. It's 1 out of every 123. And for refis, it's 1 out of every 181. But averages, 1 out of every 134 loan applications has some kind of fraud in it. So if you do the math on that, you can see that that's 0.75%. So that may not sound like a lot. 0.75% doesn't seem like a very big number. But when you look at the industry as a whole, the cost to the lenders and the financial system and to borrowers and to the entire economy goes into the billions of dollars. The billions of dollars yearly because of mortgage fraud. Mortgage fraud is very destructive. It's damaging to communities. It's damaging to borrowers. It's damaging to lenders. It leads to riskier lending. And it also creates greater losses due to higher defaults. It just is a bad thing overall for everybody in the entire economy. So there's two different kinds of mortgage fraud. There is two types of mortgage fraud. Is fraud for housing. This is where fraud is being committed usually by a borrower, but it could involve an LO or an appraiser or someone else, but usually a borrower. And the motivation behind that is housing. They want a specific house. They want a specific property. And they would not qualify for that without being misrepresenting some of the facts on their application. It could involve inflating income, inflating your assets, fabrication or lying about employment, just those type of fraudulent activities. But the purpose is they want to qualify for what they would not qualify for without being fraudulent. Now, the problem with that is obvious. I mean, if you're lying about your income and you get qualified on income that's is fraudulently elevated, once you're in that house, you're going to have to live on the income that you're really making, and sooner or later you're going to have to pay the piper, and it's going to be bad for you and bad for the lender and just bad for the overall economy. The second type of fraud is fraud for profit. This is the motivation here is money. It involves insiders in the mortgage industry, whether they be LOs, again, appraisers, attorneys, all kinds of people on the inside can join together and work together in collusion and perpetrate frauds. They're not doing it because they want properties. They're doing it because they want the financial benefit that comes from that fraud. It could involve inflated home price values, fabricated repairs and upgrades. But the point is, the motivation is for money. Very destructive. In the wake, can leave lots of people in bad shape, and it can also end up with a lot of people in jail. So those are the two types of mortgage fraud: fraud for housing, fraud for profit. This slide shows Fannie Mae's most recent mortgage fraud findings. This is from Q3 of 2023, so it's pretty recent. And this chart below shows the top 9 misrepresentation findings. That's a fancy way of saying fraud. And it shows the percentage of that fraud in the totality of the frauds that they found. So if you look at the top one, you see it's income fraud. Had 38% of the findings that Fannie Mae, fraudulent findings that Fannie Mae found came from some type of income fraud. 38% was income fraud. The second behind it was occupancy fraud. 34% of the findings they had that were misrepresentation findings, 34% of them involved some type of occupancy fraud. And as you go from there, you can see the others not as prevalent, but credit 13%, liabilities 9%, assets 6%, and then on the lower end, value fraud, title fraud, social security number fraud, property frauds. But the top two, income and occupancy. So I always want to take a minute and look at some possible red flags that come with both of those types of fraudulent activity. So income. Now this is not a comprehensive list. A good resource to go out to look at for mortgage fraud is Fannie Mae. Fannie Mae has a mortgage fraud website, has a lot of information on there. And one thing they have on there is they have different red flags to look for in different areas of the mortgage process. I mean, it's pretty comprehensive. So, but this is just a few, just to take a look. Remember, red flags are just they're a possible warning that there could be something going on. It doesn't mean that there is, but it's a warning to raise your awareness. So income. A couple of red flags. Applicant's job title is generic. That is manager, vice president. That doesn't mean that could very well be his title. It doesn't say manager of what or vice president of what, but that it can be a possible red flag. Employer's address is a post office box, or the property address, or the applicant's current residence. So that's definitely a income red flag. Employer unable to be contacted is a red flag. Pay period dates overlap and or do not correspond with other documentation. Handwritten VOEs or handwritten pay stubs or handwritten W-2 forms. Income appears to be out of line with the type of employment that they're employed with, or out of line with the applicant's age or education or lifestyle. Tax returns not signed or dated. Applicant reports substantial income but has no cash in the bank. Now again, these are just possible red flags that don't point to something. It just says raise your awareness and maybe ask a couple of questions just for clarification, not suspiciously, but just to clarify, to make sure that these red flags there's not something more to these. The next category is occupancy. That was the second highest fraud that Fannie Mae was reporting in their findings, occupancy fraud. Here we have it broken out in purchase transactions and refi transactions. For purchasing, a couple of red flags: real estate listed on application, yet applicant is a renter. Significant or unrealistic commute distance. Now, a lot of us work remotely, and that's very common nowadays, but it can also be a red flag. It just depends on what their occupation is. Applicant is downgrading from a larger or more expensive house. Again, people do that a lot, but it can also be a red flag of occupancy, that they're purchasing a smaller house, and they're saying that they're going to be their primary residence, but really they're buying it as an investment property. Occupancy affidavits reflect applicant does not intend to occupy. Definitely a red flag there. And new homeowners insurance is a rental policy. So refi transactions, a couple of occupancy red flags. Different mailing addresses on applicants' bank statements, pay advices, and etc. So that says they're wanting to refinance this house. They say it's their primary residence, but you look on their bank statements and other documentation, and the address is different. That's a red flag right there. Different addresses, the address reported on credit report. Appraisal reflects vacant or tenant occupied. So they're claiming that they're refining their primary residence, and the appraisal shows that it's vacant or it has a tenant occupying it. And then again, homeowners insurance is a rental policy. So that's just a couple of red flags for those two specific types of frauds, occupancy. So I want to take a look at this. This is a case, and this is a case that's close to home, is near, it may not be dear, but it's near to us here at Click and Close. And I looked at this in a previous anti-money laundering video, but I want to look at it again today, because it does come from our business, and it also it touches on a lot of red flags that were missed. And I just want to go through this real quickly and just point out how many red flags there were. This was a couple of years ago. That this was a loan that we made, and the borrower was qualified using income of $6,000 a month from employment as a director of sales and marketing at a printing company. Now, this was a person who lived in California, resided in California, was purchasing a house in Texas, and for the purpose of making it their primary residence. So they were qualified using $6,000 monthly as a sales director, but the qualifying income was from an employment offer letter for a job that did not start until 49 days after the scheduled close of the house. So in other words, this person wasn't employed there yet. They just had an offer letter for a certain amount of money per month. So that raises a red flag right there. Employment income red flag right off the bat. Also, the loan application reflects that the borrower had an income as a caregiver in Los Angeles and had been working there for over 10 years. And they were providing for two individuals who they lived with. The borrower had no prior experience in sales and marketing, and would be making significantly more than her historical income, significantly meaning more than double. So that definitely raises employment and income red flags. Being hired on for over twice as much as you currently make to a job that you had no experience in. Also, the post-closing pay stub provided to verify employment at the new job. It was handwritten, and it had discrepancies in both the pay period length and the amount stated in the offer letter. So that's, if you remember the red flags we just went over, that was 2 red flags for income. That was pay stubs, handwritten, and discrepancies in the pay periods. So here's some more red flags. So you can just see the red flags beginning to pile up on this loan. Search reveals the borrower owns a business. The borrower owned a business in California that employed 4 people, and this was never disclosed on her application. And then I believe finally here on this slide, a search also revealed that the printing company that provided the borrower with the offer letter, the borrower was offered a job at a printing company as a salesperson, and that printing company had the same main address as the borrower's self-employment business that wasn't disclosed. So there's an affinity red flag. These people knew each other. They were familiar with each other, and that was never disclosed. So you have got all kinds of red flags going here. Let's continue on. Mortgage with this case, there was a gift. There's nothing wrong with that, but there was a gift from a relative of $50,000, and it was disclosed. But even before the $50,000 gift, 2 bank statements prior to closing showed almost $64,000 in deposits. The maximum the borrower could have made based on her VOE was $3,300 a month. So it showed that the borrower had received multiple Venmo payments each month. This was questioned by the underwriter, but the answer provided by the borrower really didn't address the question considering the number and the amounts of the deposits made. But the underwriter was satisfied with her answer and continued on. Additionally, the beginning of and the ending balances of the account would not be considered normal for a caregiver. During the 2-month period of those bank statements, the bank balance went from $74,000 to $123,000. So there's all kinds of red flags going up here. This loan should have never seen light of day, but it did. And also there was a loan application in the file reflecting the borrower was making rent payments of $1,900 a month. And then it was changed to that they were living rent-free. So there again, more red flags coming up. The loan was a primary, as I said, the loan was a primary residential purchase. But besides previously mentioned occupancy red flags, a search of Zillow revealed that the property was listed for rent on 9/16/2021, just 17 days after the close. So this was to be a primary residence purchase, and 17 days after the close, it was being listed on Zillow for rent. So the loan closed on 8/30/2021, so that's not that long ago, and it was delivered to an investor, and this is what the investor came back with. The investor said and determined that the borrower had misrepresented their employment income and self-employment was not disclosed. The offer letter was not considered valid. The self-employment, which is all true, the self-employment was not disclosed on the loan application or verified. Using only the verified income gave a DTI of 87%. Business records confirmed that the last name of the individual who sent the offer letter matches the last name of a known business contact for the borrower's self-employed business. So there again, they knew each other. The investor determined that the borrower had misrepresented their occupancy, as public records confirmed that the borrower and the two dependents continued to reside in California. Because it wasn't a primary residence, that now the funds for closing included $50,000 in gifts. Gifts are not allowed for an investment property mortgages. So the investor determined that the mortgage did not comply with their requirements and had to be repurchased, and it ended up costing Click and Close a lot of money. There's other aspects to this. There's other legal aspects, but it ended up costing a lot of time and a lot of money because all those red flags, out of all those red flags, nobody were able to put the pieces together and say, hey, we need to take a deeper look at this. This loan should have never seen the light of day. So that was the case here at Click and Close. So how do we combat fraud? How do we combat it? We don't want you walking around, casting suspicion on everybody and everything. But how do we combat fraud? Simple ways. Number one, we just maintain awareness. Be aware. Be aware that 1 out of every 134 loans that passes through your hands statistically has some kind of fraud in it. So just be aware of that. Be aware that it is out there, and it is going to be out there. Trust but verify. That is, don't be suspicious of everything everybody says, but trust them, but also verify. Especially if there's red flags that pop up, pay attention to those red flags and ask 1 or 2 more questions to satisfy that red flag. Also maintain a policy of zero fraud tolerance. If you open that door of tolerating a little bit, that door could get kicked in real fast and become real ugly real fast, as that last case study we looked at shows. So we're all employees here at Click and Close. What's our responsibility? What should we be doing? And what should we not be doing? Well, everybody, here's some do's and don'ts for everyone. Do report any suspicious activity to the AML officer or the compliance department. Here's a good example. In the servicing a few months ago, we had a loan that was originated and began to be serviced by us, and the person in a span right after it was closed, in a span of 4 weeks, they paid the entire loan off in 4 installments, one every week. Pretty big principal payments came in through wire transfers, and within a month the loan was paid off. Now that could be perfectly legitimate, but that's not normal, and so that raised some red flags, and they contacted the compliance department, and we took their information and we followed up on it. So just report any suspicious activity. Don't investigate to determine if it's worth reporting. I mean, if you think after a few questions and then you still don't feel right about it, don't begin to dig deep into it. Just report it and let us take it from there. Do be alert during your day-to-day activities to red flags. And at number 4, don't ignore anything because you don't think it's part of your job, duty, or function. The Bank Secrecy Act dictates that as an employee of a mortgage lending company, it is your responsibility to report. Also, our policies and procedures here, our AML policy state that it is every employee's responsibility to report. And don't fear retaliation. If you report something, don't fear retaliation, especially if you report something that turns out to be nothing. That is we would rather you report something that you think is suspicious and it turned out to be nothing than you report nothing and it turns out to be something huge that could get ugly real quick. So just if you suspect something, just report it. Compliance is duty. What will we do and what will we not do? We will investigate any suspicious activities reported, and we will determine if a suspicious activity report is warranted. We won't discuss the investigation with the borrower or the people involved, and we won't report back to the person reporting. If you report something, we may get back with you for further information, but clarifications and information, but we won't report back to you whatever happened with that. What we will do, we'll let the reporting person department know how to proceed with the transaction. And we will communicate with the applicable department if it concerns an employee or a vendor or broker. What we won't do is we won't divulge the reporting person's identity. If the person asks to be anonymous, we won't divulge your identity. So that is compliance's responsibility. And then finally, okay, how do we report this? How do we make reports of suspicious activities? Very simple. Number one, do it as soon as possible. There are time frames involved. Once something is discovered or suspected, we have a certain amount of time that we can file that report with FinCEN, or we should file the report with FinCEN with a specific time. First thing you do is just report it to the compliance department. You can email me at steven.cook@clickandclose.com, or you can send it straight to the compliance department at compliance@clickandclose.com. If you don't feel comfortable emailing, you can always give me a direct call and give me the details, but you need to report details, as much detail as you can about the situation, names, dates, times, loan numbers, as much detail as you can give us, just report that. And finally, one thing that's required for us to cover is the fact that there are penalties for noncompliance, and that willful violations of the BSA requirements may result in both civil and criminal penalties. So the company doesn't want that, and we as individuals certainly don't want any of that. So the best thing to do is play it safe, and just if you suspect something, report it, and be free from any possible civil or criminal penalties coming your way or our way. Another thing is that just loss of reputation. That is something that can really ruin a company, is being caught up in some kind of fraudulent scandal, and it is very hard to recover from. So with that said, that concludes this AML training. If you have any questions, you can forward them to compliance@clickandclose.com. Again, please go on and take that